Good morning. This is Mayor Valensky with Driving Markets. Okay, so let's kick off. Anything said in this piece is an opinion only. So the markets moved higher yesterday on Tuesday, the 27th of June, on the back of the CB Conference Board Index. It's a survey done of consumers, and the consumer index effectively went up. Consumer sentiment is higher, and therefore that was just the reason, that was just the excuse for the markets to move high. The Nasdaq moved up, Dow moved up, S&P moved up. Everything looked really, really bright and green. However, it's only going to be a temporary move up. Over the next 6 to 12 months, you will see equity markets fall significantly. Okay, the reason behind that is because there is a tightening of liquidity, rising rates. You're also going to have rising unemployment, rising costs, and there's going to be a test on profitability of the companies. So the companies will start laying off more and more staff. So unemployment's already rising within specific sectors, especially in the tech sector, as Meta lays off more people, Amazon's going to lay off more people, Intel's going to lay off more people, and therefore you've got a rise in unemployment starting in the tech sector. What we've got here is very close similarities in the economic cycle at the moment between the 2008 banking crash and the 2000 .com or the .com crash of the year 2000. You've got a bubble growing, or a bubble that is forming in the Nasdaq based on AI and ChatGPT, well overvalued. Nvidia is well overvalued. I did call down Tesla to come down from 280 or 282 to 240, came all the way down to 240s, jumped back up to 247. I still expect it to reach between the 180 and the $200 level over the next couple of months. It's just simply overpriced. So they don't have enough steam in it now to push it any higher. So overall, equity markets were up. Everything's looking rosy. Bitcoin also is solid again at 30,000. Lots of views there that it's going to actually push up dramatically to 35 and then burst up all the way back up to 68 to $70,000 a coin. Could well be. It is looking very solid at 30,000, so it's forming a base there that could take it much, much higher. Some commentary, some viewers have asked me to comment on property. Okay, so you've got property in the UK and you've got property in the US. Both of them are going to fall. Two different reasons. In the UK, as more and more 2 years in fixed rates come to an end from the 2018-19 cycle that people fixed rates at 2 years or 5 years. They're going to now enter interest rate is going to be much, much higher, around about 300 to 400% more expensive, and they won't be able to afford the properties. So a lot of properties are going to come on the market either for rent or to be sold, as homeowners will struggle to maintain those mortgages. In the US, you have a slightly different scenario because their rates can be fixed for 30 years, but you've got rising unemployment and instability in the economy, and that's going to drive down real estate prices across the board. Some states are already suffering massive commercial property crash, which has started off actually in China, has moved on to the States for several reasons. One, because of drug problems and of violence problems and crime. So a lot of companies have moved out, and also a lot of companies are cutting back. For example, Lordstown yesterday filed for bankruptcy, Chapter 11 in the States. You've got Victoria's Secret filed for Chapter 11 bankruptcy in the States. Hertz Rent-A-Car. A lot of companies are going bankrupt in the US. Not only are they going bankrupt, also their suppliers that are waiting to be paid are not now going to be paid, and that's going to impact also the overall turnover of revenue within the companies in the US, in the UK, and in Europe. So you've got a big move there in commercial property downwards. That's going to fall onto real estate, residential real estate downwards in the US and in the UK. And normally there's a lag between 12 and 18 months between interest rate rises and property prices falling. So you'll see over the next 12 to 18 months, property prices will fall. Going back onto markets, the pound is looking like a buy against the euro and a buy against the dollar cable. So it looks like it's going to go up to the 129, 130 level on the prospect of rising interest rates in the UK, with inflation there really hardcore, and or headline inflation is high and core inflation is hardcore inflation. So the Bank of England is going to try and tackle that with rising interest rates. Christine Lagarde also spoke in Europe and said that rates are going to stay high for the foreseeable future and probably increase them even further. So you've got an atmosphere of rising rates or solid rates with hard inflation. Unlikely we're going to see any respite there. So the central banks have been successful effectively in damaging the economies. Overall, expect equity markets over the next 12 months to fall around about 25 to 30%. That's it for now. Mayor Walensky with Driving Markets. You can share, comment, catch me also on Instagram. Speak to you soon.